Welcome to Innova's February podcast. My name is Dan Miles, and with me I have co-founder Dinyar Irani. Price action has continued since our November podcast, so we want to give you an update on what's going on and what we're thinking about in terms of portfolios. For those that have any questions post listening to the podcast, you can either email or call Innova directly afterwards. You know how to get in contact with us. And please note that because these podcasts are recorded, we won't talk about any managers or strategies specifically, but questions in regards to managers or strategies can be asked of us directly if you wish, via email or via phone call. Please be aware that nothing in this podcast is given as personal advice. It's been designed for viewing by professionals only, and anyone wanting to make any investment decisions should do so under the guidance of a licensed advisor. So, Dinyar, if I could turn to you, do you mind giving us a rundown on what's happened over the last few months, given the turmoil from Q4 and then the rebound in January and so far this February?
Sure. Well, I mean, a lot has happened, and basically markets have been very jittery. And the drivers of that jitteriness has largely been, firstly, worries about China and trade friction. Not just the US-China trade friction, but then we've also had issues with regard to EU and Brexit issues. We've had issues around the normalisation of QE and monetary policies. That's all fed through to various fears. Most participants see liquidity and availability of credit as being key to market conditions. You've seen, as a result of that, some of the gloss coming off the growth stocks, the market darlings, particularly in the US tech sector, but also more broadly than that. You've seen, the FANGs, as they call them, Facebook come out and have results that were not particularly to the market's liking. There were things coming out, and you saw a huge one-day fall in Facebook shares. Revelations that a large portion of the accounts are potentially fake. Whilst the Facebook business is a brilliant business model, it's been priced to perfection. You've seen Apple disappoint, even locally, more recently in the last week. You've seen CSL come out with what looked like a pretty good profit number this week. It was up 10% in terms of net profit, showing growth, showing reinvestment into the company, etc. But again, shares fell. Someone didn't like that result. Again, it's been stock that's been a fantastic company, well managed, priced to perfection, and some of the gloss is coming off. So this is all typical late cycle stuff. There's a lot of fear and loathing in markets, but history suggests that markets' worst fears usually fail to come to fruition, and that's why, again, we re-emphasise that at Innova we strive to focus very dispassionately and unemotionally on what the asset valuations are telling us and our assessment of risks attached to those various asset valuations. And it pays to be contrarian, as we always say.
Okay. In regards to, there are a number of areas of the market that were, as you said, priced to perfection and would need to grow at compound rates well above what you would expect average historical rates to be. But there are other areas of the markets that's not how those markets are priced. Emerging markets and Asia in particular being one of those. Do you mind having a chat about those?
So when we look at emerging markets and Asia in particular, and let's focus on Asia because ultimately, a large portion of the non-Asian EM stuff is resources based, etc., which Australian investors already have, significant exposure to via the composition of the Australian equity market. But when we look at Asia, for instance, we see that Asia is trading about 20 to 25% cheaper than the MSCI World on various earnings measures, and we look at several of them. On a forward PE basis, 20 to 25% cheaper on things like on measures like Cape 10, so that's the cyclically adjusted PE, 10-year basis. Also around about that measure. On other measures such as price to book, it's about 35% cheaper. And this all comes with better and more sustainable potential growth rates in their economies and therefore amongst their businesses.
Which is probably worthwhile pointing out. So on the chart here, we've got on the left-hand side GDP growth from the early 80s, courtesy of the Bank of International Settlements. You've got a a yellow chart, a yellow line graph, a red line graph, and a blue line graph. The red one's pretty self-explanatory. On the key it says global. Blue, AE, is advanced economies, and yellow is emerging market economies. And you can see that emerging markets, since the mid-80s, have grown substantially above that of advanced economies. But there have been periods of time when they've grown far in excess of advanced economies. Of late, they've grown... advanced economies have probably grown higher above trend, largely because of the US, and in particular the tax cuts imparted by the US in 2017 gave a short-term artificial stimulus, and we've seen a temporary slowdown in those emerging markets due to a slowdown largely driven by China and a slowdown in China off the back of trade tariffs from the US. However, those are likely to be transitory, and we're more likely, whilst that could continue, I think the risk is more that the growth differential will separate, and you'll see a greater dispersion and higher growth in the emerging markets and lower growth in those advanced economies or developed markets. So to your point in regards to the sustainability of growth.
Absolutely. So we think the sustainability of growth is absolutely there. Obviously, this valuation discount, 20 to 30% in most instances, has some risks attached to it. So there's risks to investing in these regions, and some of those risks, we can go through them. The first one's obvious. It's escalating trade tensions. So, China is still an export-oriented economy. They're trying to change that, but they're still heavily reliant on European and US consumption, and they would slow down in a trade conflict type of scenario. India is an example of an Asian country that's much more internally focused. They have a lot of their own resources, so they're less at risk. So they're not importing iron ore, but they are hugely sensitive to energy price fluctuations. So India's a massive oil importer. There's political risk. We've seen it most recently with some of the companies. There was the furor around Huawei recently, and basically, action being taken against Huawei because it's alleged, it's believed that there might be, linkages there to the state apparatus, and that therefore it poses a spying risk, etc. Now that affects the prospects of Huawei. Another thing that brought it into focus recently was the move by Jack Ma, the founder of Alibaba, which is effectively China's version of Amazon. He recently stepped down, and there was a lot of talk in the press about why he was doing it, was he pressured from Beijing, etc., and it brought into focus some of the ties between the corporates in China, and some of these businesses are fabulous businesses. You've got Alibaba, you've got Tencent, so Alibaba being the Amazon of China, Tencent being a conglomeration of gaming and social networking, almost like a hybrid of Nvidia and the various gaming companies and say Facebook of China, etc., along with a lot of payments technology. But it brought into focus things like these the shareholding structures. Why was Jack Ma standing down? Was he being pressured by the Communist Party, etc.? We know that, for instance, with a lot of these Chinese stocks, they are operating by interposed entities called VIEs, or variable interest entities, and therefore it's hard to get to the bottom of who actually controls these stocks. These are there basically to provide certainty for the state, and it comes to the core question that, well, will the companies always be allowed to operate in the shareholders' best interests, and at what point in time does the state interest take over? Recently there was a lot of focus on these variable interest entities, and also China's supposed crackdown on some of the big Chinese tech companies that were seen as potentially having too much market power. Another example recently was Tencent, where there was a lot of state censorship of some of the opportunities that Tencent had. Most recently, it was with the blockbuster game Fortnite not being approved by the Chinese Communist Party, and therefore profit potential for Tencent being markedly reduced. With China, another risk, with China and Russia specifically, is if there is a new Cold War, and it's entirely possible that we might be looking at the early stages of this, It's always whenever there's a rising economic power challenging the incumbent. We've seen throughout history that these sorts of Cold War type scenarios can play out. In that sort of a scenario, look, the risk of foreign capital being seen as fair game would certainly escalate, and a lot of capital would avoid or flow out of these markets, for fear of being subjected to poor corporate governance or even state-based reprisals. There's things like election risk as well. Particularly again we're focusing on China here, but there is the theory that given the Chinese Communist Party's 100th anniversary is coming up in 2021, and then in 2022 is the next 5-year Chinese Congress, where President Xi Jinping will likely be the first ever leader now to run for a third term, having recently, they changed the laws to allow him to do that. So there is a theory that the technocrats within the Chinese Communist Party, within the governance structures, will deliberately slow their economy down right now to sort of address the various imbalances in the financial sectors and other sectors, misallocation of resources, such that they can be more assured of having a strong economy during this politically crucial 2021 through to 2022 period. I mean, it's only a theory, but it does make a fair bit of sense and would appear to hold some water. I mean, political imperatives are very important in a one-party state. They can take precedence. So, look, all of these risks are there. But again, we come back to the fact, well, you can jump at shadows, or you can look at the valuations on offer and assess, whether those valuations are attractive enough to compensate you for the risks. And
combined with the underlying growth prospects of the investment.
And so when we look at emerging markets in Asia, we think that on a risk-adjusted basis, they still look attractive. And we therefore retain a tilt to that area of the global equity market.
Okay, turning to sovereign debt.
So yeah, sovereign debt. Look, when we look around the world and we look at sovereign debt, I mean, there are a couple of exceptions, but there again, nothing's looking particularly attractive. So you wonder whether crunch time has to come soon. I mean, when you look at the quantum of still negative yielding debt on issue, I think it's still in the region of $8 trillion of debt on issue, sovereign, that is still negative yielding. I mean, the Swiss 10-year note is still yielding negative 0.25%, but it just doesn't make sense when you look at it. I mean, Italy, for goodness sake, Italy just last week had huge excess demand, something like $40 billion worth of euros of demand for an $8 billion issue of 30-year government bonds. And they got it away at a yield of 3.8 something percent, 3.8, 3.9%. Now, that doesn't make any sense to me. I don't mean any offence to any of my hard-working and very sensible Italian friends, but the Italian government is a different story to the Italian people. It's been a profligate government. It has not been particularly stable, and you have to ask the question: who in their right mind lends the Italian government money for 30 years at that sort of a yield? I mean, I wouldn't even lend money on that type of yield to the German government, let alone having a look at the German bunds at the moment, which for 30 years people are giving them 0.75%. Something has to give. I mean, I can kind of understand why some people betting against the euro might go in for German bunds because they want to be left holding bunds, holding Deutschmarks rather than euros if there's issues around the euro currency, but again, it just doesn't make sense. Why would you go there when there are so many other more attractive places to park your capital? It just doesn't make sense.
Well, on that, we could probably have a look at Australian government yields. Recently, so as recent as last week, the RBA, or the week before, no, last week, the RBA kept cash rates on hold. And over the last 5 months, Australian government bonds have been one of the best performing sectors of the market. And in fact, in Q4 last year probably was the best performing sector of the market. They've been a fairly volatile asset class, which they probably shouldn't be. They're AAA rated government securities. They're supposed to be quite stable, but there's been periods of time where they've had negative months quite consistently, but have come to the fore recently. And then with the RBA on hold and changing their rhetoric to go from having a hawkish bias to raising rates to saying that no, actually we're more likely to hold, the market is now factoring in a high likelihood of a 25 basis point cut. With anybody who had a chance to read the blog that I put out yesterday, it talked about the risks in that scenario. There's essentially, you're not being compensated at all for any type of inflation risk. So if we think about the scenario in which there's a continuing slowdown in housing in the Australian Eastern Seaboard, there's no inflation in regards to wage inflation, and let's say Australia does enter a recessionary period, there's absolutely the chance that the RBA might be in a position that they need to cut rates even further than 25 basis points, and holding 10-year Australian government bonds would be a reasonable place to be. And so yields could move from 2.4, 2.3 down to, say, 2%. Yep. You're not going to make a huge amount of money out of that. With a duration of, say, 6.5 years, if they drop by 25 basis points, we're talking about a 1.5% return plus a yield of 2%. Is about 3.5% return annually. That's not a stellar return, especially if in that environment equities are selling off by 15, 20%.
Or if you're a foreign owner and you're exposed to the currency risk as well.
Yeah, correct. Well, yeah, because as you would know, if you're a foreign currency holder, you have to be exposed to the currency risk unless you hedge that out. And then if you hedge that out and you're in a lower interest rate bearing environment such as Europe, you lose on the currency conversion. But what could cause the RBA to cut rates more aggressively? As I said, it could be a slowdown recession in Australia, and it could be a drop in inflation. However, there is the risk that we enter into a slow economic period, and at the same time we actually do have inflationary pressures, not domestically driven, but it could be driven globally. Because until, I guess, the most recent wage inflation figures that have come out, towards the end of last year, we actually saw wage inflation in the US, we saw wage inflation in the UK, we saw wage inflation in Europe, and we saw wage inflation in Japan, of all places. So there is pressure building on wages because of the low unemployment rates that we're seeing around the world. We're not seeing it domestically here, but we are seeing it globally. 60% of our GDP is non-tradable goods, and so is driven by the cost of production domestically, but 40% of it is imported and is imported goods, and so therefore could import inflation. If at the same time the RBA is in a position that it is cutting rates, that's likely going to hurt the Aussie dollar, and so import costs are going to go up and exacerbate that inflationary response. So the RBA could find themselves in a position, hopefully this is kind of a left field scenario and an unlikely scenario, but it's certainly a risk that they could find themselves in a position where the Australian economy is slowing, potentially going into recession at the same time that there are inflationary pressures coming from overseas. We've been the beneficiary up until about 2011 of China exporting deflation to us. Yep. They may eventually turn around and start exporting inflation to us, as would Europe and the US. So that could be a really awkward scenario where the RBA can't actually cut rates. And at the current yield on Commonwealth government bonds, you're not being compensated in any way, shape or form for that risk whatsoever. Right. You are essentially taking a bet that there is zero chance of inflation and there is almost a 100% chance of some form of deflation, which we think is a bad skew to investment. It doesn't mean we don't want to own no government bonds, but it means we want to have a reduced allocation. Yeah. They would probably still act as a safe haven asset in a sell-off. So you want to have a small allocation there because you just don't know what the future holds. But do you want to have a ton of them? I don't think that's something that you want to be piling into right now, especially given their performance over the last 4 or 5 months. Prices go up, therefore forecast returns go down, so you don't want to own as much. It's as simple as that, and everything I've just spoken about is the risks associated with that price.
Yep.
So we've talked about some of the risks in the marketplace and things that are going on. Dinyar's talked about the valuation dispersion between emerging markets and Asia and the broader globe. We talked about some of the issues in Australia. But one thing that doesn't get a whole lot of attention is potential upside. So the reality is that no one can predict the future. What we do know is that 2019, a number of things will happen that no one can forecast, right? No one knows what's going to happen. However, there are some potential upside risks. And what you'd ideally like to do, as I said in my weekly blog yesterday, anybody that read it, is if you can find assets that have priced in the downside and haven't priced in any potential upside, and you can recognize a number of catalysts that could occur, that could pay off and end up being an attractive investment. No guarantee, but at least it kind of gives you the opportunity for that skew to the right that could be the upside. So if any of the following things occur, we could see a breakout to the upside. US-China talks, Trump has already came out and said that the Chinese are treating them with a great level of respect, and he believes a deal will be met. At the end of the day, Trump is probably the greatest market watcher of all time. He wants to be seen as the guy that made markets go up, even though he probably has nothing to do with it. No. Markets go up, he's going to claim it was him. If markets go down, he's going to blame it on the Fed or external forces or whatever. But he'd like markets to go up because it makes him look good. He would like to be able to strike some kind of deal that makes him look like he's gotten a better result for the US, but also a better result for equity markets globally.
And possibly a quiet little hotel deal for himself on the side.
Which is why he wants to meet with the Chinese president directly. So a US-China trade deal is reached is likely going to lead to positive outcomes in the US, but more likely it really leads to positive outcomes in Europe and Asia, who are far more reliant on that export orientation. Italy, the Italian, whilst the European economy is doing okay, PMIs are still above 50 and they're in expansionary territory, unemployment is falling, the Italian economy is slowing. The Italian economy continues to slow. There'll be far less ammunition for the League or the five-star movement to be able to say, hey, we should be moving out of the EU if the rest of the EU is doing fine. It's very hard to argue that being part of the EU is bad if everyone in the EU is doing fine except for you because you're trying to separate yourself. So it could be that Italians end up pulling their head in and start towing the EU line and try and bring this up at a more prosperous point in time and re-engage in the breakup of the EU at a later date. Yep. I think that's far more likely. What has not been talked about a whole lot is Chinese stimulus, so the reduction of reserve requirements for the banks plus tax cuts to the overall consumer that the Chinese government has initiated to counteract the effects of the tariffs on exports and also the tariffs that they imposed on US imports in China to try and alleviate the problems for the overall consumer and for the corporates. People who haven't bothered scratching the surface immediately say, oh, there's been an enormous credit expansion in the US, so therefore there's going to be an explosion of bad debts. That's a really bad thing. No, look, that there is a risk of that, but if you really look into it, there was an enormous amount of debt held in the shadow banking system and therefore off balance sheet prior to 2015 in China. So that credit expansion already occurred. What happened since 2014, 2015 is that the Chinese government cracked down on these non-bank lending institutions and even peripheral banks that were lending off balance sheet and said these things actually need to be held on balance sheet and therefore you have capital requirements to have against those, and therefore they need to be monitored and priced. Because those businesses either needed to raise capital or couldn't afford to raise the capital, the larger banks who were well capitalized and were doing the right thing and weren't actually participating in this shadow banking expansion were able to pick up those debts at reasonable prices and are well capitalized to fund them in the case of there being any problems. So it's no surprise to us that you see this enormous expansion in credit in China all in the corporate sector because it was already there. It's now just being recorded and can be priced and monitored. So when things can be priced and monitored, you can actually associate risk to it. The Chinese government had clamped down on lending practices and non-conforming loans. And so if they are going to expand and allow for greater credit expansion, it's under a regime that is far more strict than it was as recent as 4 or 5 years ago. So we're relatively confident that an expansion in credit in China is going to be in a far more strict fashion than it was post the GFC because they recognise the risk if they don't and there's a downturn, what it can lead to. Now, there's no guarantees and it's not as simple as how I painted the picture. However, it is at least moving in the right direction. So that Chinese stimulus hasn't fed through to their economy or the economies of the world yet. And people talk about the trade surplus China has with the US. They forget that Europe has an even bigger surplus with the US. And Europe are heavily reliant on exports to not only the US but also to China. And China are a huge consumer of European goods. If the Chinese stimulus leads to increased consumption of those goods, the Chinese look to China and broader Asia look to benefit from that, and so does Europe. And if we have that combined with a US-China trade deal that is meets somewhere in the middle so that things can be sorted out, there's potential upside there that's not really priced into either Asian or European equities. Definitely priced into US equities, but not into those two areas of the market. And Brexit. I mean, obviously, there's a 29th of May. 29th of March is supposed to be the drop dead date that the British government is supposed to have negotiated a deal with the EU on their exit. It's unlikely that something is going to be passed by then. Both sides of the equation have said if we haven't reached an agreement, we're more likely to extend the deadline, because neither party wants a hard Brexit. Neither party wants a situation where the EU tell Britain, no, you can't trade with us. They initially said that that's what they wanted to do. They wanted to punish Britain to make sure that nobody else left the EU. Then they realised what the economic ramifications of such would be and the precarious situation they would be in, given that the central bank has provided a whole bunch of monetary stimulus, yet there's been no fiscal support to date. They realise now that they need to provide some form of fiscal support, and a soft Brexit is in everybody's best interest. So we think the odds are that that is what will likely occur, but there's no guarantees there. So there's some risk associated with that. But if these things pan out, you could definitely see a breakout to the upside, not to the downside. You know, albeit there's clearly exogenous shocks and things that will happen in 2019 no one's thought about. It's been 440 odd days since Rocket Man over in North Korea has fired a missile over to Japan. Who knows what he's thinking? Like, we never know. Something could happen there, or maybe the talks with the US have really settled that down. There could be another tsunami. There could be another environmental effect. You just don't know. So something could derail this situation, but there is still also real probability of a potential breakout to the upside. And where we think that would be most likely to benefit is those areas that are not overly expensive and more exposed to that upside. And those are regions such as Europe and Asia. So if those upside surprises were to occur, have a look at the world at the moment. Nothing is outright cheap, right? No. There's nothing in the world that's outright cheap, but there are areas that are kind of neutral and are pricing in uncertainty, and there are areas that haven't priced in any uncertainty and were priced to perfection, as Dinyar mentioned. They've come off a bit since October, but are still relatively priced to perfection. The US equity market in general is one of those. There are pockets in the US equity market that are quite depressed, but in general, so the S&P 500, the Dow Jones, the Russell 2000, they're priced quite expensively. Global sovereign bonds across the board are quite expensive. There's no inflation protection in any of them that we can find anywhere except for potentially India.
Ditto cash.
Pardon me?
Ditto cash.
Ditto. Cash is appalling everywhere. You don't get a return on cash. Cash rates are terrible. And because cash rates are terrible, anything that's relative to cash is not yielding a whole lot at the moment. However, if you look at things that are relatively neutrally priced, we've talked about them. Asian equities, emerging European equities. I've written here
some parts of the US.
Some parts of the US. Sorry, that I shouldn't have US and Japanese equities all look fair value. US equities don't look fair value. Pockets of US equities look fair value. Japanese equities look fair value. They're pricing in slower conditions than have historically been experienced, especially given the amount of monetary stimulus that has gone on and potential fiscal stimulus. And they're ignoring any upside from that stimulus, particularly seeing as we know that the Chinese have stimulated the economy, and it's the second biggest consumer and the second biggest economy in the world. So strategies given that landscape, we think, same as we've said before, it's relatively simple. Steer clear of expensive assets. This has been a losing trade since about 2015. Steering clear of expensive stuff has not been the trade du jour. You've been better off finding what is expensive and priced to perfection and assuming that it'll be priced for greater perfection and trying to play the game of the greater fool. You'd have made more money. If there were cheap assets available, you would concentrate and allocate to those. Unfortunately, there aren't any. So diversify amongst those fairly priced assets that have the potential to benefit from upside if things go well. There's no guarantees that things will go well, but at least you've got a call option in case they do, and have hedges in place in case things go badly.
And we'll talk about that, about some of the alternatives we've got in the portfolio as well, I guess, on a future slide.
Admittedly, following that strategy hasn't paid off. However, history has shown that following that strategy in periods such as now will eventually pay off. Things can't be priced to perfection forever and go up to the moon non-stop. They just don't. They never have. They can't. Things have to follow a pattern of underlying earnings, and earnings can't grow at 20-25% per annum across the board in an economy. Otherwise, the underlying economy or the underlying businesses would take over and become 100% of the economies in which they operate, which is mathematically impossible. And so concentrate on those areas. So they're the basic premises that we talk to. So we've got a few appendices that we can talk to. As we reiterated last time, some of the hedges that you can have in portfolios are things such as alternatives and things that can benefit in a sell-off. The alternatives that we've allocated to, liquid alternatives, it hasn't just been us that have allocated to liquid alternatives that have done badly. Everywhere around the world, anyone that's allocated to liquid alternatives, they've done badly. We've looked into why. We're not the only ones that looked into why. The biggest, most respected fundamental managers as well as quantitative managers in the world have looked into why and have drawn the conclusion that this has been a two standard deviation event from normal, but still within the realms of normality, but something you wouldn't expect more than once in every 20 years or so. However, it's very unusual, but it doesn't negate the premise in why you would want to own those liquid alternatives. One common thing, as I said in my last podcast, that people seem to misunderstand is they believe that liquid alternative assets are negatively correlated to equities. So if equities go down, they go up. They're not. They're just not correlated to equities. If equities go down, they can go down. Equities go up, they can go up. But in general, they won't move in the same direction. So in a number of different equity bear markets, you would think on average they will go up because they have a positive risk premium associated with them. So on average, they should provide you a positive return throughout time. And so you get a better risk-adjusted return in a portfolio having them in there. And at times when traditional asset classes are not providing all that much upside and there's not a whole lot of confidence in that upside, you need to find alternative sources of return, which is why we're allocating to those areas. And as I said, they tend to have no correlation with each other as well. So whilst they haven't worked recently, that doesn't mean they're not valid or they won't work in the future. It's just a matter of, investing is a long-term game. We manage risk and try to understand risk in the short term, but when we make investments and we buy and sell assets, we do it with a long-term view, recognizing what could happen in the short term. If the short-term drawdown is such that it would breach our benchmarks or breach our risk benchmarks, we don't want to take it, and we wait until the price is such that we're happy that the downside won't breach anything, but we invest in it with an assumption that we'll be holding things for a 5 to 10 year time horizon. So on that note, if you refer to our quarterly, it talks about the things we like, we don't like, what the positions are in the portfolio and why, and we've kind of gone through it in this broadcast. So on that note, I'd like to thank you, and if you've got any further questions, feel free to give us a call or drop us an email. We're happy to talk through any strategies or any managers in particular.
Yeah, please don't hesitate, guys. We always emphasise that we're very contactable and happy to field any questions.
Okay, and on that note, I'd like to thank you very much.